everyone. In this video, I'll try to explain some basic accounting terms. These accounting terms are important for solving various accounting problems. Basic terms which are used daily in a business world are called accounting terminology. So let me show you these accounting terminologies. Now, a business uses various resources, economic resources, for carrying out its operations. For example, a business may use machinery to produce goods. A business may use cash to make various payments, or a business may use bank account to receive payment or to make payments. A business may use furniture, a business may use building, a business may use stock. So these kind of economic resources which can be expressed in monetary units are termed as assets. Now, assets can be classified into fixed assets, current assets, intangible assets, tangible assets, or fictitious assets. Fixed assets. Now, fixed assets are those assets which are held for long term and they are not meant for resale. For example, machinery. Now, a business uses machinery for continuous service. It may receive the service of the machinery for several years. So these kind of assets which are held for long term and which a business receives continuous service are termed as fixed assets. These assets are not meant for resale. The other types of fixed assets are like building, furniture, land, motor vehicle, etc. Now, current assets. Current assets are those assets which are held for short term and they are meant for resale, or they can be converted into cash within a very short period of time. The examples of current assets are like cash, bank, debtors, bills receivable, short-term investments, stock, etc. Now, the amount which is in the bank can be converted into cash within a very short period of time. The debtors can be converted into cash in a very short period of time. Bills receivable are also they can be converted into cash within a very short period of time. Short-term investment also can be converted into cash within a short period of time. Stock can be sold and can be converted into cash within a year. So those assets which are held for short term and they can be converted into cash within a short time, or they are also meant for resale, are termed as current assets. Intangible assets. Intangible assets are those assets which have no physical existence and cannot be seen or touched. Now, the examples of intangible assets are like goodwill, patents, copyrights, trademarks, prepaid expenses. Now, a business uses such resources in order to increase the profit or to receive benefit. For example, the goodwill of the employees in an organization can bring extra benefit to the organization. Similarly, patents, copyright, trademarks will always bring extra benefit to the enterprise. That's why these kind of assets, which actually have no physical existence and they cannot be seen or touched, but they can be felt, are known as intangible assets. Tangible assets are those assets which have physical existence and can be seen and touched. For example, building, land, machinery, furniture, motor vehicle, etc. Now, fictitious assets are those assets which cannot be converted into cash, or such assets may not give further benefit to the organization. For example, advertisement expenses, huge advertisement expenses, uh, or a profit and loss account, if it has a debit balance, that means if it is a loss. Now, these assets are actually shown in the balance sheet and they are written off from the profit and loss account of every year. And these assets will be shown in the balances of such assets will be shown on the asset side until it is completely written off from the profit and loss account after several years. Next, we have liabilities. Now, liabilities are obligations or debts that a business has to pay after a certain period of time. Now, these obligations can be in the form of loans. Suppose a business has taken a loan, it has to pay this debt back after a certain period of time, or it can be in the form of creditors. Creditors are the people from whom the business has actually purchased goods on credit, and the business owes money to such entities or persons. So these are obligations which a business has to pay after a certain period of time, and these are termed as liabilities. Now, liabilities can be classified into fixed liabilities, current liabilities, contingent liabilities. Now, fixed liabilities are those liabilities which are payable after a long period. Generally, it is payable after a period of a year or more than a year. The example of such liabilities are like long-term loans or money raised by issuing debentures, and these are payable after a long period of time, generally after a year or more than a year. Next, we have current liabilities. Current liabilities are those liabilities which are payable within a short period of time, generally within a period of 1 year. Now, the examples of such liabilities are like creditors, bills payable, short-term loans, outstanding expenses. Now, these liabilities, like creditors, are generally paid within a period of 1 year. Bills payable also are generally payable within a period of 1 year. Short-term loans are also payable within a period of 1 year, and also outstanding expenses. So those liabilities which are payable within a short period of time are termed as current liabilities. Contingent liabilities. Now, contingent liabilities are those liabilities which are not liabilities at present but may become liabilities in future. Now, the example of such liabilities are like bills receivable discounted with bank, case pending in the court for liabilities, or guarantee undertaken for a loan. Now, to explain you an example, suppose if the business has given a guarantee for a loan, and if the loan is not paid by the person or the entity to whom the business is given guarantee, then in future this may become a liability to the business. So such liabilities which are actually not liabilities at present but may become liabilities in future are termed as contingent liabilities. Now, contingent liabilities are not shown in the balance sheet, but they are generally shown below the balance sheet as a footnote. Next, we have expenditure. Now, generally, a business spends money, or it may incur a liability in the form of a loan to receive some benefit or service, or to receive a property. Now, for example, a business may spend money to pay salary, a business may spend money to pay electricity bill, a business may spend money on carriage of goods. Now, these are generally paid to receive a service or a benefit. For example, the business may pay salary to get the service of the employees, or pay electricity bill to get the service of electricity, or pay carriage to get the service of carriage. Similarly, it may also purchase furniture, and in order to purchase such furniture or machinery or an asset, it may take a loan. So an organization, the amount which is spent by an organization or incurs a liability to receive some benefit, is termed as an expenditure. Expenditure can be classified as revenue expenditure or expense, capital expenditure, deferred revenue expenditure. Revenue expenditure or expense are those expenditure the benefit of which gets exhausted within a year. For example, if the payment of salary is made for 12 months, then the benefit of the service can be derived can be gets expired within a year. If rent is paid for 12 months, then the benefit of such expenditure will get expired within a year. So those benefit which expires, the benefit of an expenditure which gets expired within a year, are termed as revenue expenditure or an expense. On the other hand, capital expenditures are those expenditures the benefit of which last for more than a year. For example, if a machinery is purchased, the expenditure which is incurred on machinery, the service which is received from the machinery can be more than a year, because the machinery will be used for several years. So those expenditures, the benefit of which last for more than a year, are termed as capital expenditure. The examples of capital expenditures are like purchase of furniture, purchase of machinery, purchase of land, or construction of building. Now, deferred revenue expenditures are those uh, deferred revenue expenditures are those expenditures which are actually revenue in nature, but the benefit of such expenditure lasts for more than a year. For example, if the generally advertisement cost is treated as a revenue expenditure, but if the benefit of an advertisement goes on for a longer period of time and where the investment or the cost of such advertisement is huge, then such expenditures, though they are revenue in nature, but they they can be called as deferred revenue expenditure because they are revenue in nature, but they are treated as capital nature expenditures. The examples of deferred revenue expenditure are like huge cost on advertisement or preliminary expenses. Debtors. Debtors are the persons or entities who owe money to the enterprise. They owe money to the enterprise because they buy goods on credit from the business. So we can say debtors are persons and or other entities who owe to an enterprise an amount for buying goods or service on credit, and debtors are treated as assets for the business. Creditors are opposite to debtors. Creditors are the persons or the entities to whom the business owes money for buying goods or services on credit. So we can say creditors are persons or other entities who have to be paid by an enterprise an amount for providing the enterprise goods and services on credit. Next, we have purchases. Now, purchases are actually purchases are total amount of goods procured by a business on credit and on cash for use or resale. So when we talk purchases in accounting, it means the purchase of goods in which the business deals in. So if it is the case of purchasing an asset, for example, purchasing machinery or furniture where in which the business is not dealing in, then we do not use the word purchases. Purchases is used generally when the goods are purchased on credit or on cash, and these goods are meant for resale. Or in other words, we can say these are the goods in which the business actually deals in. So purchases are total amount of goods procured by a business on credit and on cash for use or resale. Next we have sales. Sales are total revenues from goods or services sold or provided to customers. Sales may be cash sales or credit sales. Next we have capital. Capital is the amount invested by the owner in the business. Now, this investment which is made by the owner can be in the form of cash or in kind. Now, in kind, it can be like assets like furniture, machinery, building, etc. So the amount which is invested by the owner in the business in the form of cash or in other forms like or other assets are is termed as capital. Drawings is actually the amount of cash or goods withdrawn by the owner from the business for his own personal use is termed as drawings. Now drawings actually decreases the capital. So we can say drawings, withdrawal of money or goods by the owner for personal use is known as drawings. So in this video, I have tried to show you some important accounting terms which are necessary to understand and to remember for solving various accounting problems. Thank you.